Assalamu-Alikum. In the macroeconomics class, today we will discuss the policy rates by RBI. Liquidity Adjustment Facility (LAF). Liquidity Adjustment Facility is a monetary policy tool used by central bank, including the Reserve Bank of India, to manage liquidity in the economy and control short-term interest rate. Throughout the Liquidity Adjustment Facility, the central bank aims to ensure that there is neither too much liquidity nor too little liquidity in the economy. This helps to maintain the inflation or manage the financial stability and keep inflation in check. So, liquidity in the banking system refers to the readily available cash that banks need to meet operative, business, and financial needs. So, what are the objectives of the Liquidity Adjustment Facility? The primary objective of the Liquidity Adjustment Facility or LAF is to manage the short-term liquidity in the economy and control the short-term interest rates. Some of the key objectives of the LAF or Liquidity Adjustment Facility are below. The first one is maintaining price stability. Liquidity Adjustment Facility helps the central bank to control inflation and maintain price stability by managing liquidity in the economy. The second one is regulating short-term interest rates. The Liquidity Adjustment Facility allows the central bank to regulate short-term interest rate by adjusting the repo rate and reserve repo rate. This in turn affect the cost of borrowing for banks, businesses and individuals. Ensuring financial stability. By managing liquidity in the economy, Liquidity Adjustment Facility helps to prevent financial instability and crisis. The fourth one is managing the money supply. The Liquidity Adjustment Facility enables the central bank to manage the money supply in the economy by regulating the amount of liquidity available to the banks and financial institutions. Controlling the exchange rate. In some cases, the Liquidity Adjustment Facility can be used to control the exchange rate by adjusting interest rate and managing liquidity in the foreign exchange market. Overall, we can say that the objective of the Liquidity Adjustment Facility is to ensure that the financial system is stable and functioning smoothly, while also promoting economic growth and maintaining price stability. So, what are the components of the Liquidity Adjustment Facility? The Liquidity Adjustment Facility typically consists of two components or operations. The first one, repo rate operation. In a repo rate operation, banks borrow money from the central bank by pledging government securities as collateral. The interest rate charged on this borrowing is called the repo rate. The central bank uses this tool to inject liquidity into the market, meaning that it needs money to become to banks in exchange for government securities. Banks use this facility to meet their short-term funding needs. And the second operation is the reverse repo rate operation. In a reverse repo rate operation, the central bank borrow money from the bank by offering them government security as a collateral. The interest rate paid on this borrowing is called the reverse repo rate. The central bank uses this tool to absorb liquidity from the market, meaning that it borrows money from the bank and offering government security as collateral. Bank uses this facility to invest their surplus funding in a secure manner. Bank rate. Bank rate or discount rate at which RBI grant loan or advances to commercial bank. Hence, it is also called discount rate. The money that commercial bank repay to RBI is the interest amount on the loans. हमने डिस्कस कर लिया प्रीवियस स्लाइड में रेपो रेट, बैंक रेट और रिवर्स रेपो रेट. उसको एक दफा फिर से देख लेते हैं. रेपो रेट में हमारे पास दो बैंक होते हैं. एक होता है कमर्शियल बैंक और द सेकेंड वन इज द आरबीआई और द सेंट्रल बैंक. इन केस ऑफ रेपो रेट, सेंट्रल बैंक से कमर्शियल बैंक लोन ले रहा है और यहाँ पर हम लिख लेते हैं लोन. और कमर्शियल बैंक जो है वो सेंट्रल बैंक को कोलेटरल देता है. तो कुछ ना कुछ गिरवी रखकर लोन ले रहा है इन केस ऑफ रेपो रेट. और रेपो रेट में हमने डिस्कस कर लिया इट इज द फॉर द शॉर्ट रन. द सेकंड वी डिस्कस द बैंक रेट. अब बैंक रेट जो है वो अपोजिट टू द रिवर्स, अपोजिट द रेपो रेट. सो बैंक रेट में क्या होता है, जो सेंट्रल कमर्शियल बैंक है वो सेंट्रल बैंक से आरबीआई से लोन ले रहा है बट कुछ गिरवी नहीं रख रहा, बगैर किसी सिक्योरिटी के वो लोन ले रहा है. In case of the bank rate or the discount rate, this is the opposite of the repo rate. The next we discuss the reverse repo rate. Reverse repo और rate, ट्रिपल आर से हम इसको कर लेते हैं. यहाँ पर हमारे पास अपोजिट होता है, यानी कि आरबीआई सेंट्रल बैंक जो है वो लोन ले रहा होता है कमर्शियल बैंक से, और कमर्शियल बैंक जो है वो लोन दे रहा है आरबीआई को और बदले में सिक्योरिटी और कोलेटरल ले रहा होता है. दिस इज द रिवर्स रेपो रेट. और इसके अगेंस्ट जो कि हमने अभी डिस्कस करना है वो है एसटीएफ. एसटीएफ में इसके अपोजिट होता है, उसको कंसेप्ट समझ लीजिए, उसको हम आगे पढ़ भी लेंगे, रीड भी कर लेंगे. उसमें क्या होता है, जो आरबीआई है वो लोन ले रहा है कमर्शियल बैंक से, लेकिन कोई सिक्योरिटी नहीं देता. कमर्शियल बैंक से लोन ले रहा है बट सिक्योरिटी के बिना. यहाँ पर जो अगर रिवर्स रेपो रेट में आरबीआई जो है वो सेंट्रल बैंक से लोन ले रहा है और कुछ गिरवी नहीं रखता, तो वो एसटीएफ की तरफ आएगा. और रिवर्स रेपो रेट में अगर बैंक जो है वो लोन लेना चाहता है, कमर्शियल बैंक लोन लेना चाहता है, तो वो सेंट्रल बैंक से को कुछ गिरवी नहीं रखने देता, तो वो बैंक रेट की तरफ आएगा. This is all which we discussed in the previous slides. Marginal Standing Facility, or we can say MSF. The MSF rate or the Marginal Standing Facility rate is the rate of interest charged by the RBI on the amount that it lent to the scheduled commercial bank whenever they face the liquidity shortfall, while the MSF rate is usually higher than the repo rate at any time. It ensures quick access to liquidity for the concerned bank. The RBI can increase or decrease the MSF rate to maintain economic stability in the country. The RBI has made the provision of the Marginal Standing Facility or MSF to help scheduled commercial banks regain liquidity quickly in case of emergency. So it is used only in emergency cases. Whenever there is a shortfall of the liquidity in the market, so they can stable the country through MSF. This can be very beneficial for the bank where all other liquidities have already been exhausted. Therefore, MSF more like an emergency monetary tool. So you have to remember the name. MSF is used in emergency monetary. MSF is the emergency monetary tool for the struggling bank. Difference between MSF and repo rate. So number one is MSF loan can be valid for the emergency purposes. In the repo rate, loan at the repo rate can be valid for the general purposes. This is the main difference. The second one is the government backed securities from the SLR collection are pledged as a collateral against loan. In the repo rate, the bank security are submitted as a collateral against loan. Here is the bank securities. And the third difference is the minimum bid size is 1 crore and the minimum bid size in the repo rate is 5 crore. Standing deposit facility, or we can say SDF. It is known as a non-collateral open-ended mechanism that allow the RBI to absorb liquidity or deposit from the commercial bank without lending government security in return to the banks. Cash reserve ratio, or we can say CRR, the amount that bank have to statutorily maintain in liquid cash with RBI is known as CRR. Statutory liquidity ratio (SLR), minimum percentage of the deposit that a commercial bank is required to maintain in the form of liquid cash, gold or government securities.